Ever feel like your bank is working against you instead of for you? Like they smile at you when you walk in, but behind closed doors they're pocketing your hard-earned money in ways you never even noticed? Well, guess what? You're not imagining it. Banks have secrets, big ones, and today I'm going to expose 7 secrets banks don't want you to know. So if you want to protect your money, outsmart the system, and maybe even use their own tricks against them, keep watching, because what you don't know is costing you. Let's talk about someone you know, Warren Buffett. Today, he's one of the richest men on the planet, but here's something banks hated about him. Back in the 1960s, Buffett discovered the power of compounding, and he realized that banks were using it against people rather than for them. Instead of letting banks eat away at his money with fees and interest rates, he decided to play their game. He created his own investment firm, made his money work for him, and never relied on banks to dictate his financial future. While most people were stuck paying ridiculous fees and drowning in debt, Buffett was busy turning a small fortune into billions. And here's the kicker. He did it by understanding what banks don't want you to know. The lesson here? Banks thrive on people staying uninformed. The less you know, the more they profit. But the good news? You don't need to be Warren Buffett to outsmart them. All it takes is understanding how the system works and flipping it in your favor. If you're ready to take control of your money and stop playing by the bank's rules, hit that subscribe button right now and let's get into it. All right, let's kick things off with one of the sneakiest tricks in banking, fees that quietly drain your money. Let's talk about the fine print. You know those mile-long terms and conditions you pretend to read when signing up for a bank account? Yeah, well, hidden in there are fees designed to drain your money without you even noticing. Maintenance fees, inactivity fees, overdraft charges. Banks are masters at creating loopholes that make them richer while you stay broke. They count on you not paying attention. And before you know it, you're getting charged for things you never agreed to or didn't even know existed. And the worst part? These fees add up fast. A small $5 monthly fee might not seem like much, but over a year, that's $60. Over 10 years, that's $600. Gone. Just like that. Now imagine having multiple accounts with hidden fees. Your hard-earned money is literally slipping through the cracks. Banks also design their statements in a way that makes it harder to track these charges. Ever noticed how they bury fees in fine print or use vague descriptions like service charge or account maintenance? It's intentional. They don't want you to question it. What's the lesson? Always read the fine print. Better yet, call your bank and demand a fee-free account. You'd be surprised how many fees magically disappear when you push back. And if they refuse, find a better bank. There are plenty out there that won't nickel and dime you. Some online banks even pay you interest instead of charging you. Also, make it a habit to review your monthly statements. Take 5 minutes each month to go through every charge, and if you see anything suspicious, call your bank immediately. The more you hold them accountable, the less they can get away with. Moving on, let's talk about another way banks quietly rob you. Savings accounts that work against you. Let's be real. Your savings account isn't making you rich. Banks love telling you to save money, but guess what? They pay you less than 1% interest while they turn around and loan that same money out at 10% or more. It's daylight robbery, but legal. Think about it. If you have $10,000 in a savings account earning 0.5% interest, that's a whopping $50 a year. Meanwhile, the bank is lending out that same $10,000 and making hundreds, if not thousands, off of it. And here's what's even crazier. Inflation eats away at your savings faster than that tiny interest can grow it. If inflation is 3% per year and your bank pays you 0.5%, you're losing 2.5% of your money's value every single year. So while your bank is making money hand over fist with your savings, you are actually getting poorer. As Warren Buffett said, if you don't find a way to make money while you sleep, you will work until you die. Banks hope you never realize this. They rely on you thinking that a savings account is the safe way to store money. But in reality, it's a guaranteed way to lose purchasing power over time. How to fight back. Instead of parking your cash in a traditional savings account, consider high-yield online banks, CDs, or even investment accounts. Your money should be growing, not sitting there collecting dust. A high-yield savings account could pay 4 to 5 times more than a traditional bank, and investing in even conservative index funds has historically yielded 7 to 10% annual returns. That's the difference between just saving money and actually building wealth. Now let's move on to one of the biggest traps banks set for you: credit cards. You might think banks want you to pay off your credit card every month. Think again. The real money is in keeping you trapped in a cycle of minimum payments and compounding interest. Banks are not your financial allies. They're debt dealers, and their goal is to keep you addicted. Let's talk about how banks trap you in debt. Ever wonder why they set minimum payments so low? It's because they don't want you to pay off your balance. They'd rather you stretch out that debt for years, maybe even decades, because that's how they make their real money. Banks also track your spending patterns. If they see you making big purchases but struggling to pay them off, they increase your credit limit. Sounds nice, right? It's not. It's a trap. They're betting that if they give you more rope, you'll hang yourself with even more debt. Credit card reward programs also play a big role in keeping people locked in debt. Banks dangle enticing cashback deals, travel perks, and VIP benefits in front of you, making you think you're getting a great deal. But here's the reality. Those rewards mean nothing if you're paying outrageous interest rates. The moment you carry a balance, the bank wins, and those perks become meaningless compared to the cost of interest piling up month after month. Another trick? The ever-increasing minimum payment percentage. Banks subtly tweak these rates over time, making sure you're barely covering the interest on your balance. That way, your principal debt never actually shrinks, and they keep collecting from you indefinitely. Now you might be asking yourself, how do we challenge the system? Let's dive in and explore. Always pay more than the minimum. Even a little extra each month makes a huge difference over time. Pay off your balance in full whenever possible. Banks hate when you do this because it cuts into their profits. Use credit strategically. Instead of letting banks profit from your debt, take advantage of cashback rewards, travel points, and zero-interest offers, but only if you can pay them off before interest kicks in. Another strategy? Limit your credit card usage to planned purchases and essentials. If you can't pay it off immediately, ask yourself if the purchase is truly necessary. Finally, watch out for balance transfer traps. Some banks lure you in with low or zero-interest balance transfers, but hidden fees and high post-promo rates can leave you worse off than before. Speaking of things banks hate, let's dive into the next secret. The stock market makes banks nervous. Banks love keeping your money in low-interest savings accounts because it keeps you dependent on them. But what they don't tell you is that the stock market has historically outperformed savings accounts by a landslide. Banks make investing sound risky because they want you to keep your money in their accounts, where they can lend it out and make a profit. They position themselves as the safe option while quietly investing in stocks, bonds, and real estate with your deposits. Banks also create complicated financial products like mutual funds with excessive fees, convincing you that investing is too complex to do on your own. They count on fear and confusion, keeping people from taking control of their investments. The takeaway? Educate yourself on investing. You don't have to be Warren Buffett, just start small. Don't let banks dictate your financial strategy. They profit when you don't invest, so take your money into your own hands. Here's a brilliant pro tip to elevate your game. Understand risk versus reward. Leaving all your money in a savings account is actually riskier in the long run because of inflation. Here's another crucial insight. Diversify your investments. Consider a mix of index funds, ETFs, and real assets like real estate to grow your wealth safely over time. Avoid high-fee financial products. Many actively managed funds don't perform better than simple index funds, but they charge you hefty fees anyway. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. All right, moving forward, let's talk about something even more shocking. Banks can legally deny you access to your own money. It sounds like something out of a dystopian novel, but it's true. Banks can freeze your accounts, delay large withdrawals, and even block you from accessing your money if they suspect unusual activity. What qualifies as an unusual activity? That's up to them to decide. Something as simple as withdrawing cash beyond what they deem normal or sending funds overseas can raise red flags, leaving you stuck without access to your own finances. Even worse, in economic downturns or financial crises, banks have been known to limit withdrawals to maintain liquidity. While this protects the institution, it can leave customers stranded, unable to access funds when they need them the most. Imagine waking up one morning, trying to withdraw your money for an emergency, and being told you can't. Suddenly, your financial security is no longer in your hands, but in the hands of a bank that prioritizes its stability over your access. To make matters worse, banks often operate under vague policies, making it difficult for customers to challenge these restrictions. The appeals process is slow and frustrating, with customers forced to wait days or even weeks before gaining access to their own funds. During that time, bills pile up, urgent expenses go unpaid, and financial stress skyrockets. Now you might be wondering, how do we challenge the system? Let's dive in and uncover the secrets. Keep emergency funds in more than one place. Relying solely on a single bank can put you at risk of being financially stranded if they suddenly restrict access to your account. Here's a savvy suggestion to elevate your game. Consider holding some liquid assets outside of traditional banking systems, such as cash reserves, gold, or even cryptocurrency, which provide alternative means of accessing funds in an emergency. If you're making a large transaction, notify your bank in advance. While this won't always prevent issues, it can reduce the chances of them flagging your account for suspicious activity. Diversify your banking relationships. Having multiple accounts with different financial institutions ensures that if one bank freezes your funds, you still have access to money elsewhere. Remember, be mindful of withdrawal limits. Many banks impose daily and monthly withdrawal limits that could prevent you from accessing large sums in one go. Understanding these policies in advance helps you plan accordingly and avoid financial roadblocks when you need your money the most. Now onto a tactic banks have been using for decades to squeeze more money out of you, and that is manipulating interest rates to their advantage. Ever wonder why loan rates seem to climb overnight while your savings account interest remains disappointingly low? Banks adjust rates in their favor, ensuring they always make a profit, regardless of economic conditions. They justify higher borrowing costs by citing market fluctuations, inflation, or central bank policies. Yet when these same factors would warrant higher savings rates, they delay adjustments or increase them at a snail's pace. In reality, banks are playing a calculated game, maximizing profits by keeping borrowing rates high while keeping savings interest as low as possible. This imbalance ensures they extract the most money from borrowers while giving the least to savers. Most customers don't realize that banks manipulate these rates not just for profit, but also to shape consumer behavior. By making borrowing more expensive, they discourage excessive spending in uncertain economic times. But when they keep savings interest low, they discourage long-term saving, subtly pushing people to invest in bank-related products like CDs and money market accounts that still primarily benefit the institution. Now you might be asking, what's the solution? Always compare loan rates from multiple institutions before borrowing. Just because one bank quotes a high rate doesn't mean you can't find a better deal elsewhere. Negotiate your loan rates. Many borrowers don't realize that interest rates are often flexible, especially if you have good credit or competing offers from other institutions. Shop around for high-yield savings accounts. Online banks and credit unions often offer better interest rates than traditional banks, so don't settle for a rate that barely beats inflation. Another smart tip? Stay informed about economic trends. Understanding how central bank policies affect interest rates can help you make smarter borrowing and saving decisions. Here's a savvy suggestion. Explore alternative lending options. Credit unions, peer-to-peer lending, and other non-traditional financing options often provide better interest rates and terms than major banks, giving you more control over your financial decisions. Finally, let's talk about the biggest secret of all. Banks don't want you to be financially independent. The harsh truth: banks thrive on financial dependence. They don't just want you as a customer. They want you as a lifelong borrower, a consistent fee payer, and someone who relies on their products for every major financial decision. If you break free from that cycle, they lose a long-term source of revenue. Think about how they market loans, mortgages, and credit cards. They make debt seem like an achievement, offering you pre-approved credit increases, flashy credit cards with reward points, and mortgage options with just the right repayment plan. But here's what they don't tell you. The moment you depend on them for financial security, they control you. Banks also discourage self-reliance when it comes to wealth building. Instead of promoting financial education, they push products that sound like they benefit you, but are actually structured to profit them first. This is why most people don't learn about investing, budgeting, or wealth creation in school, because banks prefer a system where the majority of people earn, spend, and stay trapped in the cycle of working for money rather than making money work for them. The lesson here? Educate yourself on personal finance. The more you know, the less power banks have over you. Diversify your income. Side businesses, investments, and passive income streams reduce reliance on loans and credit. Save with purpose. Instead of just saving money, put it into assets that grow over time, like real estate, stocks, or business ventures. Avoid lifestyle inflation. Just because you qualify for a higher loan or credit limit doesn't mean you should take it. Build an emergency fund outside of your bank. Having alternative sources of money ensures that you won't be financially crippled if banks suddenly decide to restrict access to your funds. And there you have it. 7 secrets banks don't want you to know. We've covered a lot, and by now, you can probably see that banks aren't just financial institutions. They're profit-driven businesses that design their systems to keep you dependent. Let's quickly recap the major ways banks keep you in their grip. First, tricky fees quietly draining your money with small, unnoticed charges that add up over time. Next, savings accounts that work against you, offering minimal interest while the bank turns a major profit from your deposits. Another critical point: credit cards are crafted to keep you stuck in a cycle of debt, tempting you with rewards that aren't worth the mounting interest. Banks use tactics designed to scare you away from investing, ensuring your money stays in their hands instead of working for you. Up next, banks use policies that let them decide when and how you can access your own money, freezing or delaying withdrawals when it benefits them. A financial system that manipulates interest rates, raising loan costs instantly while barely increasing savings rates. Finally, banks use a long-term strategy that keeps you dependent, ensuring you keep using their financial products for life rather than gaining independence. If there's one key takeaway from this, it's that relying on banks alone is not a smart financial move. The more control you take over your money, the more financial freedom you gain. True wealth isn't about how much money you have sitting in a savings account. It's about how well you make your money work for you. So here's the challenge. Start making one change today. Take one small step toward financial independence. It could be switching to a high-yield savings account, setting up an investment plan, paying off an extra chunk of debt, or even picking up a book on money management. Whatever it is, take action now. And if you found this video helpful, I highly recommend checking out my next video, which complements this one perfectly. Make sure to hit that subscribe button and turn on notifications so you never miss insights that put you back in control of your money. Let me know in the comments, what's the biggest banking secret you've learned today? I'll see you in the next video.